if we look back on 2023, there are multiple episodes where markets were just trying to read into whatever it can read into to support a more dovish narrative, only to be disappointed later, right? But the difference this time is that the pivot is pretty distinct, and the Fed is now talking about rate cuts. So the big picture is, as we look ahead to 2024, it will be a year of rate cuts as opposed to this year and last year that were defined by rate hikes. And against this backdrop, actually, cash has served us well, yielding 5%. But after peak rates, we got to think about putting money to work, putting cash to work, because in periods after peak rates, cash tends to underperform equities and bonds, which is why we're now keen to really think about the selective opportunities that we can take advantage of as we think about the year that is going to be characterized by rate cuts.
And so how do you take advantage of that in a market's perspective?
Well, right now, if you think about the very narrow market still, for example, in the US, as you know, Francine, we have been hiding out in tech and AI theme and barbelling that with front end of the curve. We lean into duration in Q4. We trimmed a little bit, but our current neutral allocation to duration still stands in contrast with the long held underweight that we had for 3 years prior to Q4. So leaning into duration within fixed income inflation-linked bonds actually could start looking interesting now, especially given the pivot, giving us greater conviction that inflation would settle at a higher level. Within equities, while our tech and AI theme has served us very, very well, and we continue to have the overweight, but I cannot help but wonder the laggards, the likes of small cap, the likes of REITs, the likes of value, we're just waiting for the pivot that we saw this week to actually start to outperform, which we started seeing. But given the very meaningful underperformance that they have delivered this year, there is a considerable room for playing catch up. So again, this is more of a momentum type of play that may well be shorter than the horizon that I typically look at, which is 6 to 12 months, but momentum is really strong. So that together with the year-end technicals may well mean that there is more runway to go. The last thing I would say, emerging markets. Emerging markets, central banks have been waiting for a notable signal like the one that we saw from the Fed this week. So emerging market valuation is attractive, and central banks already ahead of the curve with rate cuts, and now they could really be well positioned.